So in part one to this video series, we laid down the foundation on what the power dynamics between having strong cash and strong credit in relation to banking, which one was more powerful or which one was more effective in helping you to build strong banking relationships and helping you to get access to the tools you need within your banking relationship to scale your wealth. We laid down that foundation in the first video. This video is going to pick up on that and give further elaboration as to the psychology of banks, the functionality of being a strong borrower and being a strong depositor, and which route is going to again be more effective for you, how you can leverage this information to master your banking relationships so you can open up all of the tools banks have for you to start developing and growing your wealth even faster. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, the maximizing of your borrowing capacity, proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So one amazing analogy that I would like to break down for you guys to give further context to the difference between being a borrower with a bank or a depositor with a bank, and which one is going to give you the strongest connection in that relationship to that institution. You can walk into a banking institution, pretty much any banking institution across the country, walk in with $100,000, establish a banking relationship, set up checking and savings, again with $100,000 in deposit, and turn around, apply for credit with that bank, have poor credit in the process, and get denied for that credit card or loan. You can walk into that same institution with $100, set up a checking and savings account, apply for credit, have great credit, and get a credit card or loan on some of the best terms they have to offer. Why is this? Why in this scenario, this analogy I just painted, would a banking institution see more value and be willing to take more risk with you on the borrower side than if you have great credit but no deposits, versus you putting $100,000 in the bank but having poor credit? What's the difference? You have to understand that banks are looking at you on one side as a asset, as a depositor, and they're looking at you as a lender, as a liability, as a borrower. But on the flip side of that, when you go to borrow, your financial reputation with other institutions is more important in many cases than your internal reputation with that institution. There's some nuances to this. There's institutions, for instance, like Navy Federal, that have been known, if you have a strong enough personal relationship with them, that they will overlook, your rougher past or your financial report card with other institutions. But this isn't the norm in most cases. And even Navy Federal has boundaries with this at some point. You want ideally to have both in place. You ideally would love to be a great borrower and a great depositor with a bank. That's the mecca. But if you're in a situation, as I described in the first video, where you're leaning to one side or the other, then you want to leverage one side to get to the other. Your bank is looking at you as a depositor, as an asset, and they're looking at you as a liability, as a borrower, even if you're a really good one. I'm about to further break that down for you. When you are on the bank's books, you're on one side or the other. And when you are a borrower, even if you're a really good borrower, you're still technically a liability. You are a profit center for them, but you're a liability. Your likelihood is that you can cause them a loss. If something happens for whatever reasons where you are no longer able to meet your financial obligations, you can become a loss to that institution. On the depositor side, you're an even bigger profit center because your deposits can be leveraged multiple times over for that bank to make profit, as I broke down in the first video. But if you take that $100,000 out, it's not necessarily a loss for that bank in a sense of speaking. It's not a direct loss of money they've lent you. It's just you taking your own money back, and they're accounted for the fact that your deposits can be, liquid, that you could take that money out at any time. There's systems in place for that. It's not as friendly for them if you stop paying on $100,000 in debt versus you removing $100,000 in deposits. And again, your $100,000 in deposits can be lent out to potentially $1 million in loans for them, across several customers paying back varying interest rates. A lot more profitability than you borrowing that $100,000 as one customer paying that one interest rate back. So you will notice, as I explained, most institutions are going to favor you and roll out the carpet a lot more when you're a strong depositor, whether that's a lump sum of money or consistent high level direct deposits. Now, again, they're going to look for and fish for your business if you're a great borrower and don't have a deposit relationship. Don't get me wrong, but you're not going to get the same rank if as somebody with strong deposits. If you have a $150,000, $200,000 mortgage, you're not going to get the same treatment or the same level of service from that bank as somebody with 150 or 250,000 in deposits. That's facts. So you want to understand this going into the institution, because if you're looking to build a relationship with them, you need to go in knowing what side of the balance sheet you're looking to be on. Because if you're looking to go in and you're in a certain place in your financial journey where you're just out there, gathering and accumulating as much credit as you can, then you want to go in as a great borrower, and you may want to start small deposit relationships. And in some cases, you may not want to worry about a deposit relationship at all. You're just going in to leverage your great credit and get access to credit. Makes sense. But if you're looking to master a banking relationship with an institution because they have products and services that you're going to leverage to start or grow a business, to invest in real estate, they have loans that's going to help you invest in real estate. They have a brokerage firm attached to their institution that's going to allow you to start investing. This is the type of fishing that you want to do when you're looking to establish a banking relationship with an institution that's going to offer you the kind of products that are going to allow you to scale whatever your wealth growth plan is. And usually it's going to be one of these three avenues. You're either going to be somewhere in business, you're going to be investing in real estate, or investing in the stock market. There's clearly other opportunities out there, but the proven methodologies in this country have been one of those three avenues, and banks are at the center of all of them. So you want to do your homework on your institutions to find out what banks that are best located and most convenient for me are going to provide the type of loan products and deposit products and investment products, insurance products that I need to hit the markers off of my list for my wealth building, my future financial goals. And you want to start the strongest deposit relationship with them that you possibly can. And that's going to be either through deposits, direct deposits, or both. And then you want to branch out into borrowing from that institution. But the seeds that are most effectively planted are being a strong depositor. You're so much more profitable and so much less of a risk in certain ways to that institution. And they're going to treat you much more favorably. Now, again, it does not mean you can't go in as a borrower, as a great borrower, and get great treatment from that institution, but you're not going to open as many doors. So I wanted to complete this thought process for you from the first video. Keep this in mind: asset, liability. What side of the balance sheet are you going to be on? And again, if you want to be an asset to that bank, then you want to be an asset through your deposits. If you want to be a profit center, but you're still a bit of a liability, then you're going to have to go in as a quality borrower. If you have strong cash, you can bridge that into credit. If you have strong credit, then you do the work, invest, start a business, and bridge that into cash. But you have to go in with a game plan, because again, banks are at the center of building wealth in our financial system. It's not easy to get around them. I don't even recommend you try. Use your focus points to learn how the banking system works, to master it, so you can get access to the tools and resources they provide to help you scale your wealth. I know this information was valuable for you. I'm grateful to conclude this series at the moment. Comment down below. Let me know what your thoughts are on this topic. Let me know what some questions you may have, what your current banking relationships are like, and how you plan to improve or expand them. Comment down below. As always, thank y'all for tuning in. Stay focused. Stay in motion. See y'all soon.